Good afternoon. It's 1 p.m. here on the West Coast. It is November 6th of 2023. And let's get to work. My name, of course, is Robert Rayburn here at Life Pro Asset Management. And we have a lot to go through this week. We had a really strong bounce in the stock market last week. We certainly were oversold. We talked about that in last week's update where things were oversold. We expected a bounce. Now, the question is really going to be about how durable is this bounce? And that's really what we want to focus on this week is the durability of the bounce, any steps that we need to take to either prepare for a more long-lasting bounce or a bounce that may or may not fail at certain resistance levels. So the three big things that we want to focus on this week is we want to, again, do that stock market correction update. We've done that week in, week out since really the first week of August. Number two, what did the Federal Reserve say? Because that was a big spark that sort of put in a short-term bottom in stocks. We know that the conditions were right for a bounce after being severely oversold, but was there really any difference in terms of the messaging around what they said, and what does that mean for asset allocation? And lastly, how should we be thinking about growth versus value stocks? So if something structurally changed this week in terms of Federal Reserve policy, should we start to be looking back toward growth stocks and underweighting some of our value components? Or should we stay focused on this more secular shift away from growth and toward value? So we'll go through all of that in this week's update. Now, to start off, we had a really nice bounce in the stock market. So really for the first time since the month of October of 2022, we saw a really big bounce in the stock market that was accompanied by a lot of volume on those stocks that were going up in value, right? So when we look at the percentage of stocks with a 2 standard deviation daily advance, it was about 30%. So much more elevated than we've seen throughout the course of 2023. But still far short of that 64% number that we saw last year around this time. And if we look at other big bottoms around 2020, that was 75% or 69% back in 2018. So a little bit short of what we would necessarily want to say with confidence, hey, this is likely going to be a big bottom and we need to sort of go all in on risk. So still some work to be done on that front. The other thing we want to be mindful of is that the moving averages continue to slope downwards, right? So from a technical point of view, as the market has sold off since August, you're getting those resistance levels and those 50 and 100-day moving averages, 15-day moving averages, they're sloping down with the market as well. So the last 2 days of last week, so Thursday and Friday of last week, big strong rallies. And now we're getting into those congestion levels, right? So if we look at the channel that we've been in since August, sell off, rally, that's a lower high, sell off, again, rally, back into that resistance point, and again, big sell off. And now we're rallying off an oversold level. And 43.48 is a big resistance level. That is where we see sort of the downward sloping 50-day moving average. So that's something that we want to be very mindful of. 44.15 is that channel resistance, right? So when we look at that trend line going, really starting since late July, early August, that would be the next level we need to cross. So no need to be hero, I think, here to start and adding more risk to your existing risk positions. I think we can be patient on today, Tuesday, Wednesday of this week, and really kind of see, do we see that follow through action in the overall market? And by the way, getting an overbought condition in the market is not a bad thing. Bull markets often get overbought, right? That's a symptom of a strong bull market, and we're just not there yet. So the other thing we want to look at, of course, is the daily advance decline ratio for stocks. So the first few days of last week, we had 2.3 advancing stocks to 1, 1.5 to 1. Thursday, we had a 7.7 to 1 advanced decline ratio. So that's really, really good. And that's something we want to see. That said, it's only one observation, right? It's an observation in isolation. We're not seeing a cluster of that. And we'll talk about what a cluster looks like later on. But when we look at the 10-day moving, the 10-day average of advancing volume, so we look at the New York Stock Exchange advancing volume as a percentage of total issues. Again, good level, around upper 70s, 80% of issues, but not necessarily meeting that 99th percentile threshold that we would want to see, where we're seeing true panic buying, right? Short covering, big long only mutual funds coming in and doing those buyings. So we saw some panic buying, but not necessarily to the extreme nature that you would see during very long-term bottoms. Again, that's not to say that this is not a long-term bottom. We're just saying you need to see more evidence than 1 or 2 days. You need to see a cluster of events that lead us to coming to that conclusion, right? So again, we look at the S&P 500, we've rallied into this upward channel resistance point. So Tuesday, Wednesday, Thursday of this week will be very key. So what are the things? A solid rally, but we need to see a little bit more is the message here. So for the first time, to summarize sort of the technicals behind this bounce, the first time since October, we saw some real panic buying last week. A lot of it short covering, it appears, rallying into strong resistance levels. This is key. So we need to see us break above those resistance levels, and we need to see a cluster of strong days to indicate a durable low, right? So it's key not just to have 1 or 2 days, but to have 3, 4, 5 days like that. And I'm going to go back here just really quick. So when I'm looking at that cluster, this was the example of a cluster, right? So 1, 2, 3, 4, 5 days where you had these big standard deviations in terms of the percent of issues that were rallying 2 standard deviations or above on a daily basis. Right now, we've only had about 1 of those, right? So which is right here. We need a cluster. Like that really lends to some more evidence there. So the next step would be, okay, what about growth versus value? So obviously we're overweight energy. We have some technology exposure, but value is overweight in the portfolios relative to growth. What would we need to see to really say to ourselves, hey, we need to probably shift our stance a little bit and add to our growth exposure, maybe take down our value exposure a little bit? Well, one would be this relationship between consumer discretionary stocks and energy. And as you can see here, this just continues to break down. Now, this is prior support, but we really haven't had much of a rally off of these low levels. And so we'd want to see more evidence in this consumer discretionary versus energy chart that consumer discretionary is starting to make some headway. And the same with technology relative to energy as well. Again, lower lows, lower highs, a bounce here, but again, we need more evidence than 1 or 2 days. And so why do we maintain a bullish stance on energy? And we've used this slide several times, and for good reason, right? Because it's to remind clients and investors and advisors why we're so bullish on energy. Inventories do keep dropping. I think that's really, really key as supply continues to dry up. That demand for oil continues to grow. Copper has been very resilient despite sort of the naysayers about China. So if China starts to perform better than expected, both economically and consumer-wise, in terms of the level of overall notional demand, consumer demand, we would expect that pressure on oil to really start to bubble up. Major swing supplier is the Middle East, and obviously this situation with Israel and Hamas, and now bringing in Hezbollah and certain Iranian proxies within Iraq, and the U.S. involvement, all of that stuff we don't know how that's going to play out, and that's a wild card. But the thing is, we like this space regardless of the war in the Middle East. The war in the Middle East just potentially adds a little bit more upside to those values. And then, of course, structural lack of long-term investment in the ground. And that's the key. This is the most important point, I think, above all else. For 10 years, there has not been investment dollars going into the ground to support a long-term supply growth for oil and other hydrocarbons that are still the key driver of the global economy. And then very lastly, mergers and acquisitions. We're seeing more and more M&A within the shale space within the US. Why is that? Because shale is a short-term supply response. Companies don't need to put a ton of dollars into the ground to be able to adjust to rising demand conditions versus those giant oil fields like in West Africa or off the coast of the Gulf of Mexico or Brazil or Kazakhstan that require billions and billions of dollars when governments are telling them they're going to try and phase out oil in the 2030s. We, of course, think that's BS. You can't phase the world out of oil that short period of time. The technology simply doesn't exist. That's why we're so bullish on energy. So what did the Fed actually say this week, right? So the FOMC left policy rates unchanged, and we knew that. Like if you had followed the press or anything, just the general news media, no one was surprised the Federal Reserve left policy rates unchanged at 5.5%. So this was sort of a skip meeting, wait to see how the data comes in and potentially raise rates a little bit more either in December or January of next year. The Fed reiterated they're not yet satisfied with the progress being made on inflation, but they did say that they are watching rising bond yields. And that was a key statement because it told the market, hey, the Fed does not want to see long-term rates just running upward to 5, 6, 7, 8%, because that's not good for the economy, one. And two, the federal government does have very large deficits that they have to refinance, right? So while long-term there is a cap on these rates, I think the market may also be looking a little bit too much into this. I think it's the Fed saying they don't want things to get out of control, but they certainly don't want to take their foot off the gas on inflation, right? So inflation has been an issue. They want to make sure that gets defeated, and we're still sitting at 3-4% core inflation. So we need to be careful about drawing these conclusions that, hey, the rise in interest rates is done. We're going back to where we were in 2021 and 2020. We just don't see that. Inflation does remain stubbornly high. And to go back to that policy from 2 years ago will likely reaccelerate inflation. So we want to be careful with that. And of course, you saw the cover of many news magazines such as Barron's, Time to Buy Bonds, yada, yada, yada. And from an income perspective, it is a really attractive time for bonds. But from a strategic perspective, from a tactical perspective as it relates to whether to buy bonds or stocks, I think we got to be a little bit more careful there. Almost no one on Wall Street, none of the big firms have a 5% forecast on the 10-year. That's shocking considering we're in around 4.6%. And so when consensus is at a certain level, the street or Wall Street has a funny way of making the most people look dumb. And so we're not surprised, again, to see rates reaccelerate after this recent dip back above 5%. We remain in that 5.25% camp. And again, would not be surprised to see us go there. And of course, that's just the path of least resistance right now, is that 5% level. We're just not seeing anyone in that level. So if we look at whether it's by the end of this year or throughout 2024, that highest forecast is anywhere from 4.6 to 4.7%. So in summary, we like what we saw last week, but we want to be incremental, not revolutionary in terms of how we're managing risk exposures. Solid bounce, but a lot of work remains. The crowd is hoping for a top in interest rates. Again, more work needs to be done there. More work needs to be done on inflation. And the path of least resistance remains higher for rates, in our opinion. And then lastly, not much of a bounce in consumer versus energy. So we want to, again, remain steadfast in that bullish call on energy. We like the fundamentals there. We like the technicals. And that's what we got for you this week. 888-543-3776. If you have any questions, please feel free to reach out to your advisor. Thanks again. Have a great week.